This is Business Plus Weekend, a roundup of business and economy news of the week that was and what to look forward to in the coming days. 9 stories you must know about this weekend. Indian markets remained under pressure this week due to heavy selling in financials, IT and capital goods stocks amid weak global cues. In the week ended March 10th, Nifty fell 1.03% to close marginally above the 17,400 mark, and Sensex dropped 1.13% to end at 59,135. Now the broader markets remained flat, with Nifty Mid-Cap 100 rising about 0.06% this week and Nifty Small-Cap 100 dropping 0.11%. Among other sectors, banking and realty counters succumbed to selling pressure. For the week, Nifty Bank dropped 1.86% following negative cues from global markets ahead of key US jobs data that will provide a clearer picture of the Federal Reserve's upcoming interest rate hikes. On the other side, Nifty Energy, Nifty PSC and Nifty CPSC added 1 to 2%, tracking institutional money. Now, foreign institutional investors remained net buyers, pumping it over rupees 3,800 crores in the first 4 sessions of this week. Month till date, they have bought equities worth rupees 16,400 crores. Now, domestic institutional investors, however, turned net sellers as they withdrew rupees 138 crores from the Indian market. In March, they are still net buyers, having bought equities worth rupees 5,580 crores. Tata Group has filed the draft red herring prospectus with market regulator SEBI for the initial public offering of Tata Technologies. Now, this will be the first public listing by Tata since TCS's listing in 2004. The IPO is a pure offer for sale, meaning all the proceeds from the listing will go to the selling shareholders. Under the IPO, Tata Motors, which holds a 74.69% stake in the company, will offload 81.13 million shares. Meanwhile, other major stakeholders, Alpha TC Holdings and Tata Capital Growth Fund, will sell up to 9.72 million shares and 4.86 million shares respectively. Currently, Alpha TC holds 7.26% in Tata Tech and Tata Capital Growth Funds hold a 3.63% stake. Now, according to Tata Tech's DRHP, the average cost of acquisition for Tata Motors is just rupees 7.40 per share. For Alpha TC and Tata Capital Growth Fund, the figure comes in at rupees 25.10 per share. The price band for the issue will be determined in consultation with the book running lead managers based on the assessment of market demand. February has never been better. So says the Society of Indian Automobile Manufacturers, or SIAM. Indian automakers dispatched nearly 2.92 lakh passenger vehicles, the highest ever for February so far. These figures were driven primarily by a strong demand for cars and utility vehicles. The total passenger vehicle dispatches from companies to dealers last month increased 11% to 2.91 lakh units from 2.62 lakh units in February 2022. Passenger car vehicles rose to 1.42 lakh units in February against 1.33 lakh units in the same period last year. Similarly, utility vehicle dispatches, including sports utility vehicles, rose to about 1.38 lakh units compared to 1.20 lakh units in February 2022. Dispatches of vans rose to 11,489 units last month from 9,290 units in February 2022. The total two-wheeler wholesale dispatches rose 8% to 11.29 lakh units against 10.50 lakh units in February last year. Motorcycle dispatches increased to 7.03 lakh units last month from 6.58 lakh units in February 2022. Similarly, scooter dispatches rose to 3.91 lakh units from 3.56 lakh units in the year-ago period. Now, three-wheeler sales surged 86% to about 50,000 units last month from about 27,000 units in February 2022. Rajesh Menon, the Director General at SIAM, that this was the highest ever sales of passenger vehicles in February. Moving on, Bhagwat Mann-led AAP government in Punjab presented the state budget for 2023-24 with focus on agriculture, education and health segments. Now, it is the first full budget of the AAP government since coming to power in March last year. Punjab Finance Minister Harpal Singh Cheema presented the 1.96 lakh crore state budget for 2023-24 in the Assembly today. The total budget size has been increased by 26% to rupees 1,96,462 crores for 2023-24 over the previous year. The Finance Minister proposed rupees 13,888 crores for agriculture and elite sector. The AAP government announced an agriculture policy and new risk mitigation scheme, Bhav Antar Bhugtan Yojana, for horticulture producers in the budget. A free pass subsidy of rupees 9,331 crores for the farm sector has been earmarked for the 2023-24 fiscal. The Finance Minister also said that 26,797 jobs have been given so far by the Bhagwat Mann government. The minister said 10.50 lakh people have been treated in Aam Aadmi clinics in the state so far. The effective capital expenditure of the state is pegged at rupees 11,782 crores, an increase of 22% compared to the previous fiscal. Moving on to the news from the corporate world. Rohit Jawa has been named the new MD and CEO of Hindustan Unilever Limited. Now, Jawa is set to take charge from June 27, 2023. Jawa, currently the Chief of Transformation at Unilever in London, will replace Sanjiv Mehta, who is retiring from the company. Jawa will also take over as President Unilever South Asia. Having started his career with the FMCG giant as a management trainee, Jawa is credited for making Unilever Philippines one of the top 10 markets for Unilever, besides making Unilever China a competitive and profitable business. Up next, in a landmark deal in the aviation space, Boeing and GMR Aerotechnic will set up a passenger plane to freighter conversion line in Hyderabad. The development is part of Boeing's plans to expand its complex aircraft modification capabilities in India, as well as tap the rising cargo market demand. The announcement comes less than a month after Boeing bagged an order for 220 aircraft from Air India. Boeing India President Salil Gupte said its cooperation with GMR Aerotechnic supports the anticipated growth of the cargo sector in the region. Boeing expects India's air cargo growth to average 6.3% annually, driven by the country's manufacturing and e-commerce sectors. Rising temperature also brings with it fears of power cuts. In order to allay the fears of citizens dreading long power cuts during summer, the Power Ministry has launched a dedicated portal to ensure greater availability of power during the peak demand season. The portal, High Price Day Ahead Market and Surplus Power Portal, also called PUSHP, seeks to ensure all available power capacity is utilized for supplying power to consumers. The Surplus Power Portal is a one-of-its-kind initiative. Last year, the Power Minister, after taking note of the fact that on some days the prices in the electricity exchange had gone up to rupees 20, had given directions to the CERC to put a price cap of rupees 12 on the exchange so that there is no profiteering. Up next, Chinese President Xi Jinping is preparing to shore up financial stability at home with sweeping changes in financial and tech regulations. The changes revealed this week at the annual gathering of the country's rubber stamp parliament are big overhauls of the State Council, China's cabinet and government ministries. Underlying the moves is a desire by Xi and the party's leadership to exercise tighter control over the levers of the state. Now, as the Chinese president embarks on an unprecedented third five-year term, one of the most significant changes is the replacement of China's banking watchdog, the China Banking and Insurance Regulatory Commission, with a new agency to oversee the financial sector. The securities market will be handled as before by the market supervisor, the China Securities Regulatory Commission or the CSRC. But everything else will fall under the remit of a new National Financial Regulatory Administration. Now, the body will also take over some of the supervisory functions of the People's Bank of China, the country's central bank. The changes were a step towards a more international Twin Peaks model of financial regulation, with one agency covering market conduct and consumer protection and the other focused on financial system stability and policy. Up next, chaos took over the startup world yesterday when a lender sparked a wave of panic in tech circles. Now, what followed was nothing short of a crash in banking shares across the world. Events snowballed after Silicon Valley Bank, or SVB, announced a share sale to shore up its finances following a significant loss on its portfolio. After that, things went rapidly downhill. So what does SVB Bank do and why has it sparked panic? The SVB Financial Group stock collapsed 60%, wiping out over $80 billion in value. The Dow Jones US Banks Index nosedived 6.54%. SVB caters to California's tech industries and has grown fast alongside those industries for years. With the explosion of speculative financing in the coronavirus pandemic boom, deposits rose super fast. SVB's core customers, tech startups, needed somewhere to put the money venture capitalists were shoveling at them. But SVB did not have the capacity or possibly the inclination to make loans at the rate the deposits were rolling in. So it invested the funds instead, overwhelmingly, in long-term, fixed-rate, government-backed debt securities. Now this, as it turns out, was not a good idea. It gave SVB a double sensitivity to higher interest rates. Higher rates meant less money plowed towards tech and as such a lower supply of cheap deposit funding. SVB launched a $1.75 billion share sale on Wednesday to shore up its balance sheet. It said in an investor prospectus that it needed the proceeds to plug a $1.8 billion hole caused by the sale of a $21 billion loss-making bond portfolio consisting mostly of US Treasuries. The portfolio was yielding an average 1.79% return, far below the current 10-year Treasury yield of around 3.9%. Additionally, SVB has also entered into a subscription agreement with General Atlantic, a leading global growth equity investor, to purchase $500 million of common stock at the public offering price in the offering of common stock in a separate private transaction. While SVB is not a canary in the banking gold mine, its troubles could cause a general loss of confidence that would definitely hurt the sector. And that's a wrap on this edition of Business Plus. For more incisive news analysis and cutting-edge documentaries, keep streaming News 9 Plus.